If you're interested in investing in residential property, I've got some top tips that are going to make your money go further. Leverage your money to turn that money into more money. I've been a fan of residential property investing when I was younger, and then I moved into commercial property. But there are a few things that would change my mind again to make me go into residential property if these tips were all adhered to. So let's get into it and invest in residential property. Now, before we talk about these residential property top tips and making you more money for residential property investing, make sure you subscribe to the James Sinclair YouTube channel so I can help grow your business. And if you can just massage the like button beneath me till it goes blue, then we can get going and really feel happy about residential property investing. Rule number one on investing, whether it's business, entrepreneurship, into property, marketing, stocks and shares, whatever it is, you've only got so much capital. So you need to understand your cost of total capital deployed. Now let's give some working examples of this. Say you've got £1 million in a pension pot, or you've got £1 million because you've won the national lottery and you want to go and put that £1 million to work. You actually could have made £1 million out selling your business or generating cash from being just super smart with investing. So you've got your £1 million and you want to leverage it and turn it into more money. Now let's have a look at a little scenario here about buying a coffee shop chain, for example. So you've got £1 million. You could go and buy 2 coffee shops, £500,000, £500,000. That buys the freehold, so you own the property and the coffee shop. Or you could take your same £1 million and set up 10 coffee shops by leasing each property. Now that's with working as an investor, thinking, what's the cost of my total capital deployed? Could I put £1 million in and buy 2 freeholds and own 2 coffee shops, or put £1 million and lease 10 coffee shops but have 10 lots of turnover coming in? Now smart investors would say, well, your capital is being more efficiently deployed by owning 10 coffee shops and having 10 lots of turnover. For example, your 2 £500,000 ones could be doing £500,000 a year each. So you've got £1 million worth of turnover, or you could have 10 bringing in £5 million worth of turnover, which could help yourself to a lot more profit than just 2. I sit between both of these scenarios, but I know that if I own the freeholds, I control the overhead, stop the rents going up, and in 10 years' time, the value of the properties will go up further. But actually, I could have 10 coffee shops and sell them all if they're all profitable to, say, a venture capitalist, and earn myself a load of money and then go and buy a load of freehold property. But that in a scenario is talking about working your cash harder for you and understanding your risk profile. Now, when I'm investing in property or business or even into a marketing campaign, I'm thinking about what's the cost of my capital deployed. You want to get into the mindset of thinking about that before you go another step further into property investing. Right, let's keep going. Now, when I'm looking at using the capital that we're going to deploy, rule number one is I'm trying to get at least 10% rent or income on the total capital deployed. What do I mean by total capital deployed? I'm buying, say, a warehouse or a block of flats or a house, and say it's going to cost me £1 million. I'm going to put 250 cash in myself, so that's my capital, but then I'm going to use the bank's capital for the other 750,000. So that's total capital deployed, 750 from the bank, 250 from me to get that £1 million. So when I'm looking through Rightmove or Zoopla, looking for my potential investment buys, I'm thinking, right, that property there's £1 million. Can I get at least 100,000 rent or income off of it every single year at the bare minimum? And I sort of stack that up in my head. Now, if the answer is yes, then I look into it and go a little bit further and look for my return on investment. What I like about this is a time saver for the busy investor looking at potential deals, because if you're getting at least that, then you can move on and work out your 20% return on investment rule. You work out your positive cash flow. So your positive cash flows after your mortgage interest, after all your lettings fees on residential property. So what you're going to get into your back pocket divided by your total cash in. This is your cash in, not the bank's cash in, because we've allowed for the interest in here. Let's think about this as a working example. Say we've got £5,000 worth of positive cash flow after we've paid all the costs, divided by my 50,000 in to buy the property. What's my 50,000? That's my deposit, my stamp duty, my legal fees, what cash I've had to put in my back pocket to acquire the asset. Then you times it by 100 and this equals your return on investment. £5,000 worth of positive cash flow divided by that 50,000 equals 0.1. I times that by 100, that's a 10% return on investment. Actually, what we want to aim for is a 20% return on investment. Why do we want such a high return on investment? Well, we want to get as close to it as possible. Sometimes you might want to go for a lower return on investment to look for a capital appreciation, because some parts of the country, certainly here in the UK, the higher return on investment from your rental yield usually tends to mean that your value of your property will grow slower. Houses in the north of England, for example, rather than the southeast of England. Southeast of England, you've got lower yields on your rental, but good capital appreciation, doubling in value every 10 years. So you buy a house in the UK down in, say, Essex for £500,000. In 10 years, it's probably likely that's going to be worth at least £1 million. But you're going to get a low yield on your rental. Buying £500,000 worth of property up north, probably in 10 years, they might only be worth £600,000, for example, but you're going to get a huge yield on your rent. In fact, I was looking at a portfolio up north in Teesside. It was £250,000 with £70,000 of rent roll coming in on that £250,000 investment. That's a huge return on investment, but the properties might have had troubled tenants, needed lots of work. You could have people moving in and out all the time. So wherever you've got a higher return on investment tends to mean there's higher amount of work to do. So some of you might go, well, I'd be happy with 12-13% return on investment, buying slightly better locations, help myself to a bit more capital appreciation than higher rent yields. Always aim for this 20%. It's a good point to aim for, because if we have a rise in interest rates, you've got plenty of fat in the game to protect you. Now, most people, when it comes to residential property investing, are around about 3, 4, 5% return on investment. Now, if interest rates go back to 6%, which is the 300-year average, you're gonna get burnt. So that's why I like this 20% return on investment. I always think that you can find good deals that get high return on investment and good capital appreciation, but they just take longer to find those deals. And all the deals I try and do fit this, but they're all down south in the country. I've got a few in Manchester, but good ones that are down south that can still make this stack up. If you're loving this property investing video and you want to learn more, you want to get into the nitty-gritty details, then go and check out my James Sinclair's Entrepreneurs University. I've created this online training program to help people really soar to success in business and property and investing. So go and check it out at jamessinclair.net, where you can try it free for 14 days. Go on, have a look. So when I'm looking for my top saving tips for residential property investing, behind these blue sheets are my top tips. Number one is look for stamp duty multiple dwellings relief savings. Now you can find this on gov.uk, and there's a link in the video description. When you'll see on there, if you buy a property that's got multiple dwellings, you can help yourself to quite a stamp duty saving. So go and check that out. Look for stamp duty multiple dwellings relief savings. I'll probably do a video just about that in the future. I just think it's a bit too much here. Also, savings when you buy a limited company that owns property, you'll only pay 0.5% stamp duty on the shares of that company. So if you was buying a property for 10 million quid, if you was paying normal stamp duty, that would be huge. But if you're buying a property that's owned by a limited company and you're buying the limited company that owns that, pretty much like buying a business, that can be fantastic. So £10 million property, hang on a sec, 10% would be £1 million, 100,000 would be 1%, wouldn't it? So £50,000 stamp duty on a £10 million saving, compared to that would be at normal stamp duty rate. Oh my God, that's even too much for me to work out just on the video. Here's another thing, blocks of flats. Now, I don't like single let flats, but a block of flats, mamma mia, and I'll tell you for why. Over here's my little blue CAD drawing of a block of flats. Say you bought a block of flats, 1, 2, 3, 4, 5, 6, but the roof was unencumbered, not used. You could then help yourself to a new flat on the top, which is adding value. So wherever, and what that means is you manage to help yourself to that land for free. Now I know some people that are buying just freeholds of flats. So you can buy a freehold of a flat for about 25 grand. That doesn't mean you own all the individual flats, because they're all leased out. But if you can own the freehold, and I know someone that does this just in London, goes around, looks for blocks of flats where they haven't utilised the roof, pays £20,000 for the freehold, collects his ground rents, which might only be £350 a year, but then he can build a flat in the roof. Now that is profitable. You have to really hunt for these deals. Wherever you can add value, maybe there's a block of flats that you bought that have got a massive car park. With the planning rules changing now, not needing so many parking spaces as long as you've got bicycle spaces, especially in city areas, maybe you could build another property on the land. The same is with buying houses. If you've bought a house that's got a big side garden, maybe you can build another house there. Always look to add value. That's what will change my mind about investing in residential property, when you can get limited company shares or multiple dwellings really on the shares, a block of flats where you can put something in the roof or own the whole block of flats, or adding value where you can add value by building something else on the land. That's good. Next thing is BMV or motivated sellers. So this is below market value motivated sellers. There are right now portfolio landlords that don't want to be landlords anymore because of the stamp duty changes, etc., etc. Maybe they're retiring and they want to turn their portfolio into cash, and rather than waiting by selling every property off individually, they may do you a deal to sell their whole portfolio. These sort of deals I'm always looking for, because I think it's just as difficult to buy one property as it is to buy 10. So why don't you look for those below market value motivated sellers that don't want to be landlords anymore. Next, freeholds with value. That's that situation there that I spoke about that I just jumped the gun on. And I'll tell you something, in the next couple of weeks I'm going to bring out a video with a little story of how I done some of these top tips in action. So stick around on the channel and you'll see it all unfold. Make sure you subscribe, massage the like button. See you in the next video. Bye bye.